Okay, welcome back. Thank you for watching. This is this is video 5, 6 of chapter 5. In this video, where we left off, I was talking about the accelerated incentive. I was looking forward to getting to the calculations, but given the amount of time of the videos, I wanted these calculations to just kind of be in their own video so that you can review it, get practice going through the calculation of figuring out what is my CCA. So class 13 is the first class we'll discuss that does not use declining balance. It uses straight line. The ACCI is available in the year of acquisition, but that's functionally just undoing the half-year rule. Instead of adding 50% for leasehold improvements and now the UCC base for calculation, this is just talking about the regular ACCI rules. There's for improvements made between 2024 and 2027, use the regular CCA amount. So the calculation's simple right now. Any additions, we're just going to take our regular CCA. The increased CCA claim in year of acquisition does not change CCA claims for subsequent years. In final year, the CCA claims limited to remaining unamortized capital costs. Let's go into it. No, yeah, it goes right here. So let's talk about class 13. Just the next page. Class 13 additions. Vashon has a December 31st taxation year end. The company leases its office space under a lease that was signed in January 1st, 2020. The lease term is 10 years with an option to renew at an increased rent for an additional 5 years. At the beginning of 2020, the company spent $52,000 renovating the premises. In 2025, changing needs required the company to spend another $31,000 renovating the space. Determine the maximum amount of Class 13 CCA. So, here's the thing about Class 13. It's commonly called leasehold improvements. When I have a store, perhaps I'm renting the space I'm in, but I can't just rent the space and start business. I need to modify the space. I need to install shelves, maybe paint in some business colors. Maybe there's some renovations. If I'm opening a restaurant, I might have to renovate a kitchen into a space as well as a dining area. We have to make changes to the space. But when my lease is up, I leave, but all that stuff stays behind. The colors, the painting, the kitchen of like the kitchen renovations, those stay. I can't tear up all the tiles and take them with me. So what do we do about the leasehold improvements? Since those improvements are going to be lost at the end of the lease, we will amortize them over the length of the remaining lease. So how much lease can we use? Lease agreements, especially when it comes to businesses, often have renewal clauses. So the original lease is for 10 years. It can be renewed for an additional 5 years. So for this course, always take the term of the lease, and then you can add one renewal option. So our lease was originally for 10, plus our 5-year renewal. Our lease term is 15 years. When it started in January 1st of 2020, there was 15 years to go. Now in 2020, we spent $52,000. So $52,000 divided by 15 years is 3,467. We'll just do that for rounding. So every year we're going to amortize, we're going to deduct CCA of 3,467 so that when we get to the end of our lease, that leasehold improvement will be fully depreciated. Good? But 5 years later, we renovated the space for an additional $31,000. So we have 31,000, but it's no longer 15 years because 5 years have passed. Any renovation we do here will be lost at the end of the lease, and that lease is only 10 years away. So to amortize this addition, we'll have to claim CCA of $3,100 every year. So in this year, we'll claim the $3,100 for this year's additions, plus the $3,467 that we're still claiming from our renovations 5 years ago. So our total CCA will be 6,567. To see this on the spreadsheet, we have class 13 additions. Our lease term is 10 years. The renewal option was 5, so 15. When we have the renewal options, you might get multiple renewals. So you can renew 3 times for 6 years each, or 4 times at 2 years, whatever the case. We have multiple renewal options. For the purpose of this course, just take one. So we have the original lease term. One of our renewal options is 5 years, 15 is our total. Our 2020 improvements were $52,000. We're amortizing that over 15 years. Our regular improvements, or the new improvements this year, was 31,000, but we're only handling that over 10 years. So our CCA rates are straight line. Every year we will claim this for the improvements, and the total 6,567. So once you figure out that straight line amortization, we will take this number every year for the 52,000 until the end of the lease, and we'll take 3,100 every year until the end of the lease in 10 years. So next year, we've already established our CCA rates, so we'll take the same CCA. The reason it's set out like this is because years ago, when we still had the half-year rule, or when ACCI didn't apply, this was modified. So if we had the half-year rule, this would be applying 50%. So in the first year, we're taking 1,550, and then we go back to taking 3,100 the year after that. Again, half-year rule just complicates that year of purchase. But ACCI is making it 100%, so we don't need to make that half-year adjustment. So our CCA in year 1 is the same CCA in year 2. Class 14 is has to do with franchises, sorry. So because it's a franchise, it's going to be treated as if it's a new business. So it's exempted from the half-year rule because we're already going to be adjusting it for the year of for the date of purchase. ACCI applies, although results with or without ACCI in 2025 would be the same. So ACCI applies, but don't worry about it, still works out to the same numbers. So for our case, Class 14 acquisitions, R0 has a December 31st tax year end. On April 1st, R0 pays $375,000 to enter a franchise agreement. The life of the franchise is 10 years. So $375,000, Class 14 uses a straight line. So every year we will deduct $37,500 for CCA. But this is the first year, so this needs to be adjusted for the amount of time we had the franchise. April 1st, if we go here, April 1st to December 31st is 275 days. So we'll take our amortization and modify it for 275 over 365. So times 275 divided 365 comes to 28,253. So our purchase was 375,000. We will take CCA of 28,253. We will have remaining $346,747. That's the amount of UCC that will be available. And next year, we'll subtract 37,500 in UCC in CCA next year, leaving us with 309,000 going into 2027. So every year after that, we'll just take that 37,500. So hopefully that makes class 14 understandable. Class 53. Class 53 is manufacturing equipment. Its usual CCA rate is 50%. Right now, the ACCI is still functioning like it used to, whereas instead of removing 50% on additions, we're adding 50%. So the CCA rate on additions to 53 is going to be 150%, 150% times its 50% CCA rate, which means additions will take 75%. So existing UCC will amortize at 50%. New additions will amortize at 75% in that first year. In effect, a 75% write-off in the year of purchase, where the year is 2024 or 2025. So going back to our example, class 53 is the next one. On January 1st, Arco Inc. had a class 53 UCC balance of $500,000. In 2025, a property with a capital cost of $100,000 is added to the class. There are no dispositions in the year. What's the maximum class 53 CCA for 2025? So for class 53, we started with 500,000. We added 100,000. So in total, our UCC is $600,000, our starting amount plus our net additions. We take 50% of our starting balance. So of the existing assets, we'll take CCA of 250,000. The additions of 100,000, we can take 75%. So 250 plus 75, our total CCA is 350,000. So we're going to deduct that much from our income for CCA. 600,000 minus, sorry, I said 350. That's 325. Sorry about that. So 600,000 minus 325,000, that leaves us with a UCC of 275,000. So we add our additions to our existing UCC, subtract the CCA taken, UCC going forward is 275,000. To do this same calculation in the usual format, 500,000 plus $100,000 makes 600,000. And the ACCI adjustment will add 50% of additions. That makes our CCA base $650,000. At 50%, our CCA will be the combined 325, which we have up here. And then we need to undo the 50%, the $50,000 adjustment to our UCC to get us back to that 275,000. If you have questions on how this is working, I'm willing to answer them. Just email me. This is the way it's done on the tax return. I find that for students, this way is more understandable. It gets us to the same result. Our combined CCA will still be 325. Our UCC will still be 275 at the end of it. Okay. Let's do, I'm going to skip zero emission vehicles. They're kind of new rules, but they operate very much like class 10 and 10.1. The only difference is electric vehicles are recognized as being more expensive, and so they have an increased recognition rate of 61,000. So if I get a regular passenger vehicle, I can't claim above $38,000, or I can't add. But in a zero emission class, we can add up to 61,000. That's the biggest change between them. Electric vehicles have a higher threshold before they're considered luxury vehicles. But we don't give you any zero emission calculations in this course. So I'm going to skip through in the interest of time to get to short fiscal periods. In first or last year of carrying on a business, a fiscal period with less than 365 days may occur. So CCA needs to be prorated based on the relationship between days in actual fiscal year and a full year. We exclude class 14 because class 14 already considers proration in its formula, and individuals earning rental income don't consider short fiscal periods. If you have a rental property, you just take a full year's of CCA. In general, because houses usually increase in value, most landlords, most business owners that rent properties commonly choose not to take the CCA on them. Anyway, so the short fiscal period, 294. Whoops. Yes, I know it doesn't exist. I accidentally added it. Bear with me a moment while this freaks out. capital cost allowance. And we're going way down to short fiscal periods. Olander begins carrying on a business on August 1st. On September 15th, the company purchases $115,000 in Class 8 property. The year ends December 31st. No other depreciable property is acquired or disposed. The property is eligible for the accelerated incentive. Determine the maximum Class 8 CCA for this shortened fiscal period, as well as the UCC balance going forward. So, from August 1st to December 31st is 153 days. Even though the asset was purchased on September 15th, we're not prorating to when the asset was bought, we're prorating to when the business began. So the business existed for 153 days. The acquisition amount was 115,000. So the max CCA will be 115,000. So 115,000 times 20%, normally 23,000, but we need to adjust it for the number of days in the year. 153 divided by 365. So that means our CCA that would have been $23,000 is now only going to be $9,641. Its UCC remaining will be $105,000, $105,359. That will move into next year where 20% can be taken on it then. So that's short fiscal period. It's a regular CCA calculation, but just modify that CCA for number of days. The other format has it here, comes to the same number, 9641, 105,359 going forward. Okay. I think I have just a couple slides. Yeah, we have some time. So I'd like to finish this up, and then the next videos we'll discuss disposals. Class 14.1 is goodwill, excess of purchase price over fair market value. So when I buy an asset or when I buy a business, they tally up the value of all the assets. Let's say it's $1 million. But when I purchased it, I paid 1.3. What the CRA considers they consider that goodwill makes up that additional amount. If I only got $1 million of value, but I paid 1.3, I must have seen $300,000 of additional value. I must be getting, if this is a fair trade, I must be getting $300,000 of something. And that can be internally generated goodwill. It's the personal factors attributed to the business. It can be the business's reputation, its brand, if there's an existing customer list. When I buy the business, I'm buying with it all of the relationships that can't quite be quantified. So goodwill is considered, if I pay more than what a business is worth, that excess amount must be the goodwill of the business, those good relationships. Unusual capital expenditures. It's not associated with property acquisition. So when I buy a business, these excess amounts are added to 14.1 as goodwill. So every time I expand my business, the excess amounts will add to one instance of goodwill. So goodwill for each business is in a separate 14.1. If integrated business, one single goodwill account. So I have two businesses. I print t-shirts and I make jeans. So if I purchase a well-known t-shirt brand, that goodwill will be included in my t-shirts. If I get a brand deal with Levi's or some other jeans, adding that to my business will create goodwill. If it's the same business, if they both exist in one corporation where I just sell high-end brands or high-end clothing, well, now all that additional goodwill goes into one account because they're no longer separate businesses. So one business can only have one goodwill account. Included in this is other intangibles, customer lists, unlimited life franchises, cost of government rights like quotas for farmers, and appraisal costs associated with intangible properties. From an accounting perspective, intangible assets aren't really amortized, but from a tax perspective, they just attach a small CCA rate to it, 5%. These things are kind of expected to last forever. So we use a small rate, 5%, similar to how we'd amortize a building that's expected to last, 80 years. So we've been discussing CCA. What are the tax planning considerations? CCA deductions are discretionary. We usually want to claim the maximum, but we can claim nothing and anywhere in between. If we have a current year loss, we can deduct CCA to increase that loss. Now, might be beneficial because losses can be carried back to apply against earlier income. So we can apply that loss to an earlier tax year and get a refund of taxes already paid. But if we don't have income last year, then maybe we want to hang on to the CCA. Let's not deduct it now. Let's leave it until we have income in the future. If we have multiple classes, let's say our income is, $10,000, but our total CCA is 18,000. So we don't want to claim all of it. We just want to get it to zero. Which classes do we take first? The usual wisdom is whichever class has the slowest amortization rate, take that first. Does it go into the calculation for it? It's a little different. Anyway, what I was saying is take it first, because if we have a class one at 4%, it's going to take 80 years to fully amortize that. Whereas if we have a class that applies the CCA rate at 55%, our computers, that's mostly amortized in 3 or 4 years. So if we don't need to take all the CCA, let's save the CCA we can take quickly and use up the CCA that we have to wait for. The CCRA audit that results in increased business income. So if you get an assessment from the government and they've modified your income, so now it's higher than you expected, you're allowed to revise those CCA claims to get that income back down. CRA will allow revisions to CCA claims in income tax returns that have been filed and assessed in certain circumstances, as long as the request is made with period to file notice of objection. If period to file the objection expired, revision allowed only if no taxes were payable for that year. So in 2025, Rubal carries on a business as a sole proprietor. He needs a $30,000 CCA deduction to achieve his goal. He can claim a class 14.1 that uses 5% with a UCC of 600,000, or take it from class 10, 30% with a UCC of 100,000. The maximum CCA claim from both classes would be the $30,000 he needs. So if he takes the claim from 14.1, the UCC balance drops to 570,000. So next year he can still claim 28,500. Maximum claim in 2026 of 30,000 for class 10 stays the same. So his total CCA he could take next year's between the 2 years is $88,500. So that's if we start with the low rate. It leaves more CCA available to claim. If we had taken from the high rate and left the low rate alone, the balance of the $100,000 class 10 goes to 70. So next year we can only claim $21,000. Class 14.1 stays at its $30,000 amount. So the total CCA claimed in 2025 and 2026 would total up to $81,000. So it's just trying to illustrate that taking the slow moving CCA rates usually works out better than claiming all of the higher ones. Now, if you have enough income, claim everything. But if you're limited in how much CCA you can take, start with the low classes first and then build up to those faster classes. Because that way next year, it'll leave more CCA that can be taken right away. By choosing the lower rate, it provides Rubal with an additional $7,500 in CCA claims. There are rules around immediate expensing, the DIEP. I'm not going to do those for now. Extended immediate expensing. And then we go into dispositions. So I'm going to stop there. We've talked about introducing the concepts of CCA. We've talked about the various classes The most common class is class 1, class 8, and class 10. A lot of our examples will use those classes. Class 50 for computers is also very popular. I've shown you the basic calculation. It gets confusing when we have the half year rule and the accelerated incentive, but lucky for you guys, right now they're undoing each other. So it's like they're not even there. So it's as simple as ever. If you have any questions for how to do these calculations, please let me know. If the videos were unclear, I can re-record a few of them or maybe an adjustment just to explain some of the minutia. I want students to do well. This course, this chapter is where they always struggle the most. And I think it's just because of the high number of classes and applying that half rule, the half rule and Aki rates. Otherwise, thank you for your time. I'll see you in the next video.